Joining us now is PIMCO economist Tiffany Wilding. Are you seeing the evidence of weakening in the economy, and to what extent?
Yeah, well, I mean, I think the bottom line is that the U.S. economy, as well as developed market economies, have been much more resilient than anyone expected in the first half of this year. But nevertheless, we do think under the surface that, monetary policy drags are starting to build. And that just plus the fact that some of these fiscal policy positive overhangs that we've had since the pandemic, excess consumer savings and the like, those are starting to diminish. So, in our view, this does start to decelerate in the back half of this year and in the United States. And by the way, we're already starting to see that in other developed markets. So, yes, we do see signs that things are weakening.
Does that turn the bond story around? Does that lead to a bid for treasuries? Because that has been the big headwind for stocks and now added concerns about a rate shock for the consumer.
Yeah, I mean, so I think the bond market right now, or just markets more broadly, are kind of searching for a level of financial conditions that's tight enough to start to slow the economy. And I think that the markets were basically repricing to this outlook that maybe you need more financial conditions tightening in order to really slow things down. But I think nevertheless, what we look at and we see under the surface is that things are slowing. Maybe it's happening with a little bit more of a lag at this point. But yes, eventually, that should help, create some value or perceptions of value in the bond market as the economy slows.
Tiffany, one of the more difficult things to get our arms around has been the level of excess saving, and there's been all kinds of revisions, and no one really has a clean model on what is left in consumers' bank accounts versus pre-pandemic. I wonder if you think, A, that's important enough to really concentrate on, and if it is, where are we?
Yeah, and I agree with you. There's quote wide uncertainty bands right around these types of estimates. But I would really just highlight that when people look at this, they tend to look at it on a nominal basis, and that's not really the way that we should be looking at it when thinking about real consumption moving forward. We really have to deflate it. The price levels have adjusted quite a bit over the last several years, and consumers. The bottom line is consumers can buy less with the savings they had, and that goes for wealth as well. After you deflate it, the excess wealth that we've seen since the pandemic, also looks like it's come down as inflation has risen. So we do think that is, and again, this is not only in the U.S., but we do think those excess savings are getting depleted across the developed markets. And at some point, you're going to have consumption that just comes into that new reality.
Tiffany, do you think then this all means that the Fed is done, or will they go in November?
Yeah, I mean, I think that the Fed has said that they are very data dependent. And when we look at our near-term inflation forecast, I think there's a pretty good case to be made that they're going to look good going into the November meeting. The next CPI report that we're going to get, you're still going to have some nice tailwinds for the Fed in terms of the decline in used car prices. Obviously, you have rents that are still decelerating as well. So I think the Fed can look at that, and they can say, hey, maybe we can wait a little bit longer. They continue to be data dependent. Their newest SEP forecast, which had inflation still running, I think, at 3.5 as the midpoint at the end of this year, still looks a little bit high to us. So maybe that's the catalyst for them to say, hey, we might take a rate hike out for the end of this year. But nevertheless, even if they do that, they're going to continue to say, that they're data dependent. We really think the Fed is watching the unemployment rate here. Until you get some increase in the unemployment rate, they're probably going to still have this type of hawkish, more hawkish rhetoric.